In this lesson, we're looking at pay-as-you-go tax, and that is deducted from our gross pay every payday in lieu of paying a large lump sum at the end of the financial year. So in lieu just means instead of. So what that means is when you work, you pay tax, and at the end of that year, it means even if you weren't supposed to pay tax, if you crept over that tax-free threshold, then it means that you've at least covered yourself for that. So that will usually always happen, and that's done as your employer estimates how much tax they need to take out, so that at the end of the financial year, you don't have any tax that you need to potentially pay. So your employer estimates how much tax to take out each payday, and at the end of the financial year, your actual income tax is calculated. They'll supply you with a PAYG payment summary, and it shows your gross pay and PAYG tax paid. You're then required to submit a tax return to the Australian Tax Office, or the ATO. The ATO then calculates your tax and Medicare levy, and if you've paid more tax than you needed, you'd receive what we call a tax refund. So that means you get money back. But if you've paid less than you needed to, you have a tax debt, or another word, or it could also be liability, or a bill that you need to pay. So we always want to be getting a tax refund or to break even, as opposed to having that tax debt or tax liability, because then you're required to find money to pay back to the government because you haven't paid enough. And that's not what we want to be doing. So our tax refund is our PAYG tax paid, and then minus our tax payable and plus our Medicare levy. And our tax debt is again our income tax payable plus our Medicare levy minus our tax that is paid. So it all sounds a little bit confusing, but hopefully with a few examples it will make it a little bit easier to understand. So John earns $105,970 and claims tax deductions of $2,248. Last year he paid a total of $30,180 in tax, so we need to firstly calculate his taxable income. So his taxable income, remember, is our gross income minus any deductions. So his gross income is $105,970, and his deductions up here, so $2,248. So we get $103,722. So this is what we work with now, the 103. So we need to calculate the income tax table by referring to the income tax table. So if we think back to last lesson that we looked at, we had that tax table. So our tax, this would be sitting in our fourth bracket. So that means in that fourth bracket, if I go back up, if I have a look, my fourth bracket is here. And so we need to pay $19,822 plus $37 over $87,000. So we're paying $19,822 plus our 37 cents, so as a decimal, multiplied by our taxable income, which is this, and I need anything that's over $87,000, which is multiplied by this 37 cents. So this tells us our tax payable is $26,009.14. The Medicare levy. So our Medicare levy, remember, is 2%, and that is paid on our taxable income. So 2%, 0.02, on our taxable income of $103,000 tells me my Medicare levy is $2,074.44. And the last thing we need to then calculate is, does he need to pay anything to the government, or does he get a refund? So if we look at the total amount, it's $26,009.14 plus $2,074.44. So that equals $83.58. So it says back in the question that he paid $30,180. So this is less than 30,000, so that means he's entitled to a tax refund. So 30,180 minus 28,083.58. So he should get back $2,096.42. And that's what we want at tax time. We don't want to be paying anything back to the government.